Good afternoon. Welcome to Wednesday. I'm Bill Hammond. This is Real Estate Raw. Thanks for joining me. This week we're going to be doing a market update, be a year-end multifamily market update. So that's what we're going to get into. It is also Fed meeting day, rate day. So got my phone open over here looking for the updates. Let's keep an eye on that. See if the Feds raise the rates or don't raise the rates today. Discuss that as the meeting goes on. Anyway, thanks for joining me. As you're coming in, whether you're watching this live or you're watching this someday in the future, post over here. Tell us who you are, where you're from, what city you're from. Make sure we get this networking going on here. I want to introduce Monica Wyndham as always. Monica is sort of the other side of this real estate rock company here, helps me do everything. Monica also is a property manager extraordinaire, so if anybody has anything property management wise, certainly reach out to Monica. Again, I want to welcome everybody coming in. Hey, Jack, good to see you. Let everybody know who you are, where you're from. Post over here in the chat. Tell us what city you are. Anyway, so today is Fed Day. I can always count on Jack. Jack, keep an eye on it. Do they raise the rates? I've got my phone open over here, so let us know when we get a message whether they did or they didn't raise the rates. Recap from last week. Got into talking about CapEx. So we have CapEx, capital expense, talking about when should we use money that we raise or cash flow for doing CapEx. And that was last week's meeting. So if you missed that, if you need to kind of find out about when you should be doing CapEx, some budget tips on CapEx, things like that, then go back and watch last week's meeting. Kind of talked about, again, when should you raise money for doing big projects and when should you use cash flow for fixing stuff up, and is now the right time to be doing projects and renovations. So that was last week. Go check that out. That's in the thread. Again, thanks everybody for joining us. Let us know who you are as you're coming in. Fed rate raise day. I'm updating my phone. Let me know if we find out if the Feds raise the rates today or not. Currently, we're around 5.25 and a half or so, 5.25, 5.5 for the Fed rate. It's putting a lot of our commercial rates in at around 7 to 8, 7.5, give or take. Let me know if you see anything less than about 6.5, 6.75. If anybody's got any quotes lately, share that with us. Seems like about 6.5, 6.75. That's pretty much Fannie Freddie type range right now, kind of going into the end of the year. Right now is also a tough time for debt. Just beware, you're not, the deal flow is normal. I put out an email the other day. Hopefully you all saw it. Deal flow this time of year is slow. It's totally normal. It's the holiday season. On top of, we're having a bit of slowdown in the market. We'll discuss that today. Deal volume is down. Transaction volume is down considerably. I think we're down like 70 some odd % year over year. But at any rate, so that's what we're seeing going on there. Got a lot of opportunity coming up in the new year, so we'll talk about that as well. All right, so Fed meeting day, if they raise the rates, how much, quarter point, are they going to not raise it? I think they're probably going to hold steady. We'll see. The market's doing pretty well. Market as far as the economy is concerned, looks like our job growth is doing pretty good. Looks like our overall economic metrics are doing pretty good, which, by the way, is always the backbone for multifamily. So when you're talking about the sort of metrics for whether the multifamily market is good or not, the fundamentals of multifamily, that's always going to be job growth, employment, wage growth, things of that nature. So as long as we see like wage growth, job growth, things like that doing okay, the multifamily will have its micro ups and downs. I know a lot of you follow me. We've talked about that. Sort of the 2-3 year window will go up and down in value, but the macro cycle, 5 to 10 years, is almost always up and to the right. So you just got to kind of pay attention to your short-term cycle. Make sure you don't get yourself caught out. Again, appreciate everybody stopping by. All right, so market update. Did the Fed raise rates? Did anybody see? I'm not watching it now. My phone's not on anymore. Let us know if they raised rates. Keep an eye on that. I think they announce around 2 o'clock. Anyway, so going forward, market update. Let's good. We got rates coming in. I think they're going to hold those steady. All right, but let's talk about for a second here. Rates going up, going down, and the difference between rates and appetite for lending. I know a lot of people right now have loans coming due. You may have debt that's matured over the last couple of months. Everybody was talking about this maturity wall that we had coming due. This $8 billion of worth of debt, all maturing in November, December of 2024. Looks like there's been a lot of extension, pretend and extend there. Looks like a lot of the lenders have given extensions on a lot of that debt. There was not a massive wall of foreclosures. The world didn't go straight to hell in a handbasket like a lot of people predicted. So we'll see, what goes on. hold rates and projected 3 cuts in 2024. All right, Alan, so they held the rates level this time, it looks like. So good. Thanks for the update. All right, so that means rates around quarter, 5.25, 5.5, somewhere around that range on the Fed side. Okay, so appetite versus actual rates. So people, we're talking about these loans coming due. We got a lot of maturity exposure. Looks like a lot of those loans got extended, maybe out about 6 months. That means a lot of people are going to be having maturity over 2024, right? So you're going to be mid 2024 is where you're going to start to see a lot of that reset again. Are the rates going to come down fast enough, low enough to allow everyone to get out of that deal in 6 months? Maybe, maybe not. I mean, even if the points, the Fed, as they have done today, held steady, which is good, but they certainly didn't lower anything. And even if they lower rates, they would need to lower rates several points for a lot of the deals that we see out there to start working out, right? A lot of those properties were bought back in 2021, 2020, whatever, at a 3.25, 3.5% interest rate and resetting into an 8, 8.5, that debt service ratio doesn't work out so well. So I don't think that you're going to see rates come down fast enough to allow for the market not to have some damage, not to have some collateral damage, and for there not to be some foreclosures. I believe there is definitely going to be. You're going to see that start hitting around March, maybe late summer next year. But the Feds are just not going to lower the rates fast enough to save the market, and I think that's very intentional on their part. I think they're going to kind of allow some of the damage to be done in the commercial space. But again, we're talking about the interest of a lender as well as the interest rates. Sure, interest rates go down, and that'll be great, but that doesn't necessarily mean the lender has more appetite for lending. Now, when we're talking about rates and we kind of just act like, when the Fed set the rates, that's just it for the world, you're largely talking about Fannie, Freddie, agency debt, large commercial loans. Yeah, those are pretty much set just based on the rates, kind of moves with the federal rate. But over here at Community Bank or somewhere that you might be doing more local business with, it's not really pegged to the Fed rate as much as you might think. Over there at Community Bank, you're going to have a lot more personal appetite and emotion based into that branch's lending or that bank's lending, right? So if they've got a lot of exposure to multifamily or commercial, or they're not confident about the market or the economy or the chair that the Fed that morning, not the Fed, the board of directors for the bank or whatever the case just isn't comfortable with the world, they'll stop lending. I was talking to somebody the other day that their credit union just stopped lending for 90 days, just shut down all lending for 90 days. So you never know. So small banks, it's different. We're seeing the lack of appetite there resulting in higher rates for longer, I think. So if you're at a small bank, and I say small bank, I mean anything less than non-recourse loan with CMBS type debt agency, Fannie, Freddie. If you're at a bank of somewhere with branches and things like that, pay attention to this. There is another point that I've been making with a few different people that I'm talking to, some students and some clients. Hey, listen, if you're having a loan come due, if you've got debt that's coming due, if you're having some issues with the lender, you're not alone. So there is safety in numbers. And I've always told everybody, I don't mind having a problem as long as everybody has the problem, right? I don't like being the only one with the problem. Well, right now there are a lot of problems. So I think we'll do maybe next week or so we'll do a call on sort of how to deal with banks, or maybe after the new year, how to deal with debt and deal and negotiate with banks. I've been through a short sale and I've been through a foreclosure, so I understand sort of how to deal with lenders through distressed dispositions. I've been there and done it. And so what you want to do is there's some tricks, but everybody, the banks all have problems. You just want to be the smallest of the problems. And that's what I'm working with on all my clients, and I know Monica is as well, is if you're having trouble with your debt, trouble with your bank, talk to us. We might be able to help you out, no guarantees, but call us because we can show you how to maybe not be the biggest problem the bank has. And then perhaps you'll get to survive a little longer. And the rates go down at a point in time, you can refinance or sell, and you may get out of the deal. But anyway, sidebar. So that's kind of the difference between rates coming down and the appetite staying up there. We'll see. A lot of banks, I think mid-tier banks are having some balance sheet trouble and may for the next year or so. So what does that mean? Well, it means that several things. It means creative financing, right? And that's why I've been teaching that, and I wrote the book Creative Cash. And that's because that's going to be a hallmark of business going forward. If the mid-tier banks, which support so much of our lending in America, especially in the multifamily space, sort of lose appetite for multifamily or a certain type of multifamily, let's say older buildings, we've been talking about that, If you're, that's going to make creative financing really very valuable skill set in that sort of C space or affordable housing space. We're talking about those older buildings, 1960s, 1970s. Hey, did anybody not see the news? Corner of the building up in, I think it was Brooklyn, collapsed. Was it 2 nights ago? So again, another property that has hit a certain age that it physically fell down. I think these kind of the properties that lenders are going to have a hard time lending on, and insurance is going to be tough on those. So we want to kind of have my opinion, flight to quality. This is also, I think, a big hallmark over 2025. You're going to 2025, 2026. You're going to see the higher end assets, the A minuses, the B pluses, really go up in value, and I think you're going to see the C's, the affordable housing space, really kind of fall in value. I got to go back and find a slide. I think, Monica, you may have been at the presentation, but about a year, 2 years ago or so, I was giving a presentation, and I showed a chart where I showed the market splitting, where all real estate, multifamily, A, B, C, D, has always gone up and down in value together. But I think for the first time in history, we're going to see in 2025, maybe 2026, 2025, you're going to start to see a real bifurcation of value where A's and B's really go up in value, and the C's in the affordable housing space does not go up in value. So you heard it here. It's personal prediction. If you're looking to be an LP, invest passively. Someone's bringing you a deal. Location. You really want to be focused on that location. Quality of assets. So be careful about older buildings right now, unless you've got a lot of capex to come in there and fix those properties up. So that's one of the big things I think we're going to see next year, sort of a split in the market. So you can say you saw that here first. All right. Deal flow slow right now. We talked about that. It is going to pick back up generally right after NMHC, National Multifamily Housing Conference, right? NMHC. It's the large realty conference. It's out in San Diego, the 29th, I believe, this year. Somebody correct me if I'm wrong. But big conference that's always for the multifamily realtors. Now, it's not just multifamily realtors. And by the way, strongly recommend if you're out that way going. Massive conference. All the who's who show up at NMHC each year. Well, most, I'm not going to be there, but most everybody who's going to be out there. But anyway, big conference. All of the realtors trying to hold their deal flow and their listings together for NMHC. A lot of business gets done at that conference. And so right after that's when you typically see a big wave of deals hitting the market. So I'm going to say February, March, you're going to start seeing a lot more just organic listings. And then midsummer to late summer, you're going to start seeing the distressed assets hit the market. So that's my outlook for mid-24. Again, job growth, everything in there looks good. Our economics look good. Obviously, the Fed agrees. They didn't raise the rates today. So that's pretty good. We don't have to worry about that. Turnover. All right, so that brings me to my next point, turnover here. So I think a lot of people are starting to see high turnover in their apartments. Let me know if you've seen that, post in the chat. But yeah, a lot of people turning over, a lot of properties turning over. Terry, no, I think it was January 29th. Sorry, I think that whatever it says, January 29th, I believe, is NMHC. Somebody looked that up. My apologies. Anyway, so turnover. I think a lot of the C space right now has seen turnover. A lot of tenants that were good tenants all of a sudden becoming not great tenants, and you're starting to see turnover. It's not you, it's not the property, and it may or may not be the management. What is common in this market cycle is as those rates go up, your tenants are getting hit in the expenses, the utilities, their credit card bills, all those sorts of things. And so where these tenants once could afford to live in your unit at that rate, all of a sudden they're having to make different financial decisions. And so we're seeing turnover, we're seeing people come together for roommates, things of that nature. So right there, be a little careful about one bedrooms going forward. They don't offer a lot of variety for people to get roommates, things like that. So you may see less rent growth in the one bedrooms. 2-3 bedrooms are probably better options in more of a downturn market. But you're going to see some turnover. If you are seeing turnover right now, if you're having tenants move out, get your units back online, safe, clean, affordable. That's all you want to do. Now is probably not the time to be renovating. You probably don't really want to go in there and try and do heavy renovations, especially if you're having turnover. Just get those units back online, get them safe, get them clean, get affordable, get a head in the bed, and let's keep going. Don't go in there and try and do big, giant renovations. That being said, let's talk about big giant renovations for 1 second. I've mentioned this several times in different lectures lately, and I think it's worth mentioning again. You need to understand, especially in this market, the difference between rent growth and loss to lease. Major difference is going to be a big issue going forward in 2024, right? So if you have a property, and let's say it's 20 units, and 15 of them are rented for $1,000, and you've rented out 5 of them for $1,200, right? And you've renovated those 5 units and you've got the $1,200, and now your plan is to move the other units from 1,000 to 1,200 after proving the model. That is loss to lease. That is great. That is a good thing to do that. So if you've proven the model, then you're burning off loss to lease, which means the difference between market rent, your $1,200, what you have proven, and effective rent, what be $1,000, what you're actually getting for the other units, with a $200 loss to lease. Raising the rent is when the realtor or the seller or someone comes in and says, hey, all the units are in for $1,000, but we're pretty terrible operators. We're real stupid and you're real smart, and you'll just be able to magically raise the rents and make a whole lot of money, and so it's a great deal. Pay us a lot of money for it. That's raising the rent. That I would be extremely careful about right now. We're seeing in almost all of the cities, rent growth is either level, declined in some cities, like Atlanta, we're seeing down a couple points. But you have to understand, that's a couple of points down off of a 20% high. So the rent's jumped up a massive amount in the last couple of years, and so it's down just a little bit. So it's still, very, very high. But again, the difference between loss to lease and growing the rent, be very, very careful about rent growth. Just going out and exploring and trying to buy a property because you think you can just raise the rents to a new market. That's not something you want to be doing right now. Burning off lost lease is always a great value add model. So just make sure you understand the difference. Especially, this is a big one, especially if you're an LP and you're investing in some GP's deal. Make sure that you really are understanding where those returns are coming from. I'm seeing a lot of GPs that kind of project returns based on a lot of future rent growth, not loss to lease, not things they're doing right now. And that makes for a risky investment. So that's kind of the difference between loss to lease. Don't want to go catching the falling knife. I would say right now, try not to do the big renovations unless you're really getting the money and you're really sure of it. We're moving into an operator market, less of a speculator market. Last couple of years, speculator market. Next couple of years, operator market. You're going to have to learn how to really run property. You're going to have to get with people that truly understand business and the business of multifamily, right? Let me point something out. Multifamily is an even split between business and asset, and it's one of those weird investments. Not many are like that, where it's very split between the building, the location, the physicality, and how well you can run that property, how well you can manage it. Again, the location, the tenant base, all that stuff. So you have to understand both sides. Well, the market over the last couple of years has been making a lot of stupid people look really smart. So be careful, right? The tide has been floating all the boats, and so you've been able to make mistakes and it just kind of get covered up. That's not going to work going forward. You're going to need to really work with people that are true operators and truly know what they're doing. So again, LPs, make sure you're really vetting those GPs, make sure they know what they're doing. Where were they in '08, by the way? That's what I always like to ask. Where were they in '08? A lot of opportunity coming. I think we got a tremendous amount. I've been saying that. I'm going to keep saying that. I think 2024 is going to be the real shift in the market, where we go from the seller's market squarely into a buyer's phase two, straight into it, right? We're going to skip phase one. We're just going to go full on phase two. And I think that's what we're going to see in the upcoming market. I don't think a lot of sellers are going to sell if they have to. So I think a lot of the deals that you're going to see for the first 6 months, a year, in 2024, 2025-ish, or excuse me, 25, 26, is going to be distressed assets. So you're going to have to really get good at underwriting, really learn how to underwrite those deals, figure out what you're doing going forward, and make sure you understand underwriting. Going to be tremendously valuable or important going forward. All right, so I don't think I'm going to check my calendar. We are probably not going to be able to do another meeting next week. I think I'm traveling for family, so this may be the last meeting for the year. If that is the case, then we'll meet again in January. Be doing an update then, give you some updates going into the new year. We're going to do another big meeting. I think we're going to do it in February. We're going to do a webinar where I go and do the bus tour. If you guys haven't seen the bus tour, virtual bus tour, go check that out in the thread down there. Do another bus tour where I take you through my entire portfolio on Google Streets, kind of drive you along. I'll show you how I financed all those deals. That'll be coming up in February, so make sure you stay tuned to that. Go over to Real Estate Raw, the website. I've got a ton of articles in the free resource section, so if anybody needs material to read about real estate, tons and tons of articles over there. Absolutely go check them out. Happy holidays, Merry Christmas. Thank you all for stopping by. We'll see you next year. If you need any help this year, if it's management, reach out to Monica. If you need any kind of lending, operations help, anything like that, certainly reach out. I'm going to put a link in this thread here. If you want to book a call with me, 15-minute call, find out about my program, see if there's something I can help you with, just click on the link. I'll put it in here in just a second. And talk to you next time. See you next year, probably. Take care.